Google is making fresh all-time highs. The stock is up more than 100% from its lows. Everyone is suddenly calling it an obvious AI winner. And that's exactly what makes me uncomfortable, because the best time to buy great companies is usually when nobody wants them, not when they're being celebrated at record valuations. So today, let's talk about Google, not the hype, not the headlines, but the risk you're taking right now if you buy at these prices, not financial advice. Okay, I get the hype, I get it. The stock looks unstoppable. AI momentum, Gemini headlines, Buffett headlines, new revenue streams, and honestly, a few months ago I would have been much more interested, but price matters, and expectations matter even more. Let's get the obvious bull case out of the way in about 30 seconds, because every other YouTuber is already doing this part. Google is clearly winning the AI narrative right now. Gemini 3.0 is being positioned as best in class. Perplexity hype has collapsed. Gemini is taking share from OpenAI. OpenAI is burning cash at an insane rate. Google is massively profitable. TP could become a new revenue stream. Berkshire Hathaway disclosed a $4.3 billion position. All good points. I agree with most of them. Now let's talk about what actually matters. Sentiment check. Sentiment on Google has completely flipped. Earlier this year, people were convinced AI would destroy Google search. Now the story is the opposite. Google is untouchable. And when sentiment moves this fast, risk usually hides underneath the surface, especially when a stock is making all-time highs. Deep risk analysis, the part people ignore. Risk. Number 1, this rally is mostly multiple expansion. This is the most important point in the entire video. Since the March 2025 bottom, Google's operating cash flow is up about 14%. The stock is up over 100%. The multiple expanded by nearly 78%. That means the majority of this move is valuation, expansion, not fundamentals. And multiples do not expand forever. At today's price, Google is trading at a price to operating cash flow of approximately 25, the highest level since 2009. The long-term average is around 17.5. So yes, Google is a better company today than it was in the past, but it is also the most expensive it has been in 16 years. That matters. Risk number 2, expectations are now very high. If you're buying Google here, you're implicitly betting on two things: sustained double-digit cash flow growth, either stable or even higher valuation multiples. Let's be realistic. My calculation gave Google a fair value of around $300. For Google to double again from here, you'd need cash flows to explode and the multiple to expand toward 50 times operating cash flow. That's not investing, that's hoping. Risk number 3, AI is a margin wildcard, not a free win. Yes, Google is winning in AI, but AI is capital intensive. Running Gemini at scale is expensive. Google can afford to bleed OpenAI dry, that's true, but that doesn't automatically mean shareholders win. AI could compress margins, increase capex, delay returns, great for dominance, less clear for returns at today's price, especially when there are other asymmetric risk-reward opportunities presently available in the market, for example, United Health. Risk number 4. The Buffett signal is being misunderstood. I've seen the posts. Buffett is buying at all-time highs. What does that tell you? That's not how this works. Berkshire bought sometime during Q3, likely well below $243, possibly much lower. And let's be honest, there's a very slim chance Warren Buffett himself made this call. Google is not traditionally in his circle of competence, and he said that himself. So no, this is not a guaranteed Buffett stamp of approval at today's price. Valuation versus reality. I ran the numbers. If Google grows operating cash flow at 15%, buys back 2% of shares annually, reverts to its historical multiple, You're looking at roughly 9% annual returns over 5 years. That's fine, but it's not exceptional, especially with this level of risk. Even with optimistic assumptions, higher growth, and higher multiples, you're still not getting a return that screams must buy at all-time highs. Great company? Absolutely. Great investment right now? I'm not convinced. Final verdict. For me, this is a wait. Not because Google is a bad business, but because the risk reward is no longer asymmetric. I would be buying Google anywhere below $250, preferably below $220 when fear is high. Multiples are compressed, market crashes, or expectations are low, like earlier this year. At today's price, Google has to execute nearly perfectly just to outperform the market. That's a tall order. I could be wrong. The business could exceed expectations, but I'm not willing to bet on that at an all-time high valuation. Waiting is a position. That's just my take. If you disagree, tell me why in the comments. If this helped you think more clearly about risk, leave a like. And don't follow anyone blindly. Thanks for watching.